This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. You know, I love technology, but I have to admit, it is so unpredictable. This podcast coming up, great podcast with Gil Morales, but I'm telling you, we had more issues with Skype. But I think we've on the editing side, we've got it all fixed. But bear with us on a couple things. And there is one moment where, right at a critical moment, Gil gets beeped by a Skype misstep, and he's actually saying Michael Jackson. So just bear that in mind as you listen. But definitely an interesting podcast. But we try our best with Skype, and sometimes it works for us, and sometimes it doesn't. But anyways, enjoy. So today on the show, I have Gil Morales. And I think Gil's going to be an interesting comparison to my world. And I'll explain what I mean by that in a second. But anyways, Gil got started in the early 90s. He's a broker with Merrill Lynch up in Beverly Hills. I'm sure there's some great stories with that. And you moved on to work with William O'Neill, IBD fame, CANSLIM fame. We're a portfolio manager there, ultimately became a market strategist there, and has moved on to operating your own investment advisory now with Chris Kacher. And I have to mention your book right here at the beginning, because I've talked about it on Facebook some, Trade Like an O'Neill Disciple, How We Made 18,000% in the Stock Market, by Gil Morales and Chris Kacher. Gil, thank you for joining me today.
Thanks for having me, Michael. Great to be here.
Now, so you're up in Playa del Rey today, yeah?
Yeah, we're along the beach, just north of LAX, and beautiful day today, so enjoying trading from the beach as always.
I'll have to share with you my only Playa del Rey story. Years ago, probably, if you've been there for a while, maybe you were there, but it was the late 90s. I was visiting a friend in a separate bedroom, and she comes running in the middle of the night, and she's like, "What's that? What's that?" My bed is moving across the floor. And I look at her, I'm from Virginia. I look at her and I go, "It's an earthquake. You live here." We go outside. It was like one of these little two-story places where there was a pool in the center courtyard, and it looked like a wave pool. It was the coolest thing. My first earthquake in Playa del Rey. So. Cool stuff.
Well, we get them, definitely. So to me, it's kind of, I just pull out my surfboard and ride the wave there. So,
one of the things I was thinking about before our conversation, and I'm going to let you explain some of the differences and whatnot. And I was thinking about, for people out there that want to, and I saw a little bit of this on Facebook, folks are like, well, what are you going to say about Gil's book and whatnot? But I was thinking, it reminds me of going to Tokyo for the first couple times, because you go to Tokyo, and it's a parallel world. You're like, everything's different, but they're doing the same thing. It's the same trains, the same cars, the same buildings, but it's just different. So it's going to the same place, but maybe getting there in a different way is kind of how the setup to letting you walk into telling us some about your style of trading.
Well, I would say our approach, as you put it, that's an apt title, techno-fundamental. But I would have to say, in my experience, the fundamentals really provide a backdrop, and it's really the technical action that tells all. And I found when I get in trouble, it's when I'm leaning too far to the fundamental side, maybe falling in love with the story too long and not really paying close attention to the technicals. But I find in general, if I stick to the technicals, I can't go wrong. We actually do use a market direction model that is based on nothing but the market technicals.
Let me before we get into the details, I want to take you back to early times, young Gil times. Because we were just we were just talking. I was telling you right now that the downtown San Diego is setting up for Comic-Con, and if anyone's ever been here, it's an absolute zoo. Right. And the first thing you said to me, and I was going to ask you earlier about what you were doing when you got started, and you mentioned a really interesting starting career path.
That's true. Right when I got out of Stanford, actually, when I was getting ready to graduate, I had done a comic strip for the prior 3 years. I graduated in '81 from Stanford with an econ degree, which I refer to as E with a big C-O-N, the big econ. And I had done this comic strip, Doopy, since the time I was a sophomore until I was a senior, and it's very popular. It actually became something of an icon on the campus. And when I graduated, my advisor, John Cogan, who actually was Undersecretary of Labor under Reagan. He told me I had two choices. I go to graduate school, business school or whatnot, or I could start a business and actually learn about business. And so what I decided to do, since I had done this comic strip and since it had been successful on campus, I thought, okay, I'll put it together in a book and basically put it together in mock up form and went to a publisher, 10 Speed Press in Berkeley, and I had a couple of purchase orders from bookstores in the area, and it was enough to cover the cost of printing. So I took those purchase orders over to the 10 Speed Press guy, and he agreed to print the book for me on the basis of the purchase orders. So got the book printed, 15,000 copies, sold well enough that Ballantine Books out of New York came along and published a second edition of the book, which I think is Doopy, The Life and Times of a College Student or something like that, or Wake Me When the Semester's Over. I think that was a title that Ballantine Books had given the second book that I did. But yes, I was a cartoonist, and I somehow segued into the financial arena. But in a lot of ways, looking at what's going on these days, it all seems to make some sort of perverse sense.
Well, so talk about that transition. So you ultimately... was your first job a stockbroker in Beverly Hills for Merrill Lynch?
That was my first job in the financial area. Before that, I actually had been the editorial cartoonist for the Malibu Times just before that. And I actually did win second place from the California Newspaper Publishers Association in 1995 for cartooning. But I started in the business in 91, so I was kind of doing that and started to become a broker so I could make some money because I found out that cartooning doesn't pay. And I had tried to become a cartoonist. I got very close to being syndicated in my mid-20s and became a graphic artist, graphic designer, actually helped design a educational software game that was put together by the Learning Company. They came public, I think, in the mid-90s under the symbol LRNG, but they've since been, I think, bought up by Broderbund. But back then the game was called Robot Odyssey 2. And I was doing that and a few other things in the graphics area. And then I moved to Maui thinking I was going to become an artist and a painter. So I was going to try my hand at watercolor painting, and that all failed miserably. So I came back to California from Maui and got the...
So, I'm going to have to get on all these trader types that I keep talking to, because what happens is we do these Skype calls and everyone has got their laptops or whatnot running 16 million applications, and it kills bandwidth. And then we have to go to a landline once these things start pixelating. So anyways, we're back to Gil, and you're ultimately making the transition because, listen, the only thing I really want to know right now, there's a lot of things I want to know, but I want to know the craziest story that happened, the most insane thing you saw without naming a name, working in the Beverly Hills office of Merrill Lynch. Because look, there's a lot of wealth in Beverly Hills. Okay, there's a lot of wealth, and a lot of people, maybe in Middle America or whatnot, they might think Beverly Hills, all these really, really smart folks. And I'm not saying there's not. There's a lot of smart people there. However, there are some crazy people in that town with lots of money. So come on, give me the craziest thing you saw, or have I put you too much on the spot?
There are a couple of crazy. I mean, we used to see Rodney Dangerfield down in front of the office every morning in his pajamas, walking his dog and mumbling to himself. So we'd always say hi to Rodney on our way out to pick up some coffee early in the morning, just before the opening at 6:30 a.m. But I think the craziest thing was when I went. There was a good swell coming in, and I was going to go surfing, so I went down to the parking lot. I'd left around, it was about 2:30. And went down to my car to get in my car and head off to the beach, and my car is being blocked by a limousine, and the door's open, and so I kind of was hoping I could move the limo so I could get out to the swell, and I peer in, and it's Michael Jackson, and he's sitting there. Apparently he sent some of the people up to the Sharper Image, which was on the first floor of our building. We were up on the second and third, to get some gifts, I guess. And I asked him, is it okay to move your limo? If you could, please, I'd like to get out. And he said, oh, well, I can't. I don't drive it, and blah, blah, blah. So I went back upstairs, and my assistant said, well, what are you doing back here? I thought you were going surfing. I said, well, I can't. Michael Jackson's limo is blocking my car. And she says, Michael Jackson's limo? At that point, every woman in the office immediately screamed and jumped out of their seats, and they all went running down to Michael Jackson's limo. and pretty much surrounded the limo so that I couldn't get out for about another hour. But I think that was the craziest mob scene I've ever seen.
Well, I don't.
Is that crazy enough for you?
Yeah, I just know it's an interesting town, to say the least. You never know.
Once I almost ran over Jamie Lee Curtis.
There you go.
Who was jaywalking. If I had, that would have been something to tell.
You never know. You never know what you're going to see in LA. That's for sure. Let me move you on though, because I know that.
I'm just filming things and whatnot. So.
Yeah, the brokerage days are a long time ago. I think for listeners though, and for people that perhaps have your book, I think the ultimate transition is to move into is once you took a position. I know you were recruited by William O'Neill and you joined his firm. And you're ultimately a portfolio manager there, a market strategist there. Here's the thing where I think people could use some education. Mm-hmm. Why don't you go ahead and give people kind of this broad overview of William O'Neill's strategy, which is ultimately the foundation of what your current strategy is today? Is that a fair assessment?
Oh, definitely.
Yeah. So why don't you give people a broad overview about joining O'Neill and what you were indoctrinated to, what you began to learn there?
Well, when I started out as a broker, you never were actually in the financial industry yourself, correct?
I guess I don't know what the official definition of that is. No,
well,
I've never worked. Put it this way, I've never worked for
retail brokers.
I've never worked for anybody. There we go.
Okay. Oh, good. Yeah, smart man. So. In any case, when you start as a broker, you're trying to grasp onto what you're going to sell, basically, because it's all about selling. And so I just found I gravitated towards stocks and read a lot of different books. And being a cartoonist, having been a cartoonist, I'm very visual. And so when I came across O'Neill's book, it immediately resonated with me because it wasn't fundamentally based. There wasn't a lot of gobbledygook about fundamentals and valuations and whatnot. It's very simple for me to understand, and the patterns are very simple for me to understand. So I immediately gravitated to that. But the premise of O'Neill's work is that if you go throughout history, there are essentially models of stocks that have been big winners, and they all have very similar characteristics. And a lot of them are truly the companies that are on the entrepreneurial leading edge of the economy at any given point in time, something that I used to refer to as the big stock principle. And it's something that was conveyed to me by O'Neill just in the way that he built his portfolios and the stocks that he focused on. He only went for the big stocks like the Apples, the Googles, the companies that are at the leading edge at any given time. And he was able to pick out where the institutional money had to go based on the fundamental outlook, in other words, the growth outlook for the company, as well as its position within the economy as a cutting-edge type of company. And so what he did is he identified characteristics that are set forth in his acronym, I guess, or whatever you call it, CANSLIM. Current earnings, annual earnings, has to have new products, that's the N. S is sponsorship, or actually supply and demand, that's looking for companies that are showing big upside volume. Leader or laggard, you always want to go with the leader, so you wouldn't buy Microsoft in the 2000s, you would buy Apple. Microsoft being a laggard, Apple the leader. And then institutional sponsorship, he wanted to see institutions taking positions in this. So the I in CANSLIM, refers to institutional sponsorship. So Bill had a very good sense of where the institutions needed to be in terms of how they structure their portfolios and the holdings that they would have. And then M is just a general market direction. And I think that's the real trend following portion of O'Neill's strategy, where he's only long the market when you're in a bull market. And he doesn't really short the market, but I do short the market, and we only short the market when you're in a bear market. So the M stands for the market direction. So it's essentially just a basic set of criteria that any investor can use for stock selection. And then he goes into a whole rigmarole of different chart patterns that you're looking for in technical action in terms of breakouts that would issue buy points and points where you would add. And so it's really a techno-fundamental system, but it focuses, to me, I thought the money-making aspects really focus on, A, finding that big stock, and number two, handling correctly according to the trend and the technicals. And that, to me, the technicals overrode everything. That's the essence of O'Neill's system. And, of course, we've added our own work. My partner, Chris Kacher, our own work.
So I know this is another one of these, you would think with technology, I mean, Gil and I probably would have been better driving to see each other today. We're only about 90 minutes away from each other. And, technology is just crapping out on us today. So anyways, we've readjusted and we're back in the flow again. Gil, let me take you right in, because you were talking about some of your background at William O'Neill and some of the things that you've learned. But I know, as you mentioned in the beginning of our conversation today, quite an evolution and much more of a price action type mentality. But why don't you address for me kind of a day in your life?
My day starts getting up at 4 o'clock in the morning and checking the news over just to see where the trends are, what's going to happening in the market that day. If there are any stocks gapping up or down, I want to be alert to that. So I'm just looking over things in the morning, but I probably do that for about a half hour, 45 minutes, and then have some tea and some breakfast, and then go out for a run. I know it sounds weird maybe right after I'm eating, but that's what I do. And that's around 5 o'clock, and by the time I get back and take a shower, the market's ready to go. And so we're just watching the market, and if alerts are hit, basically set sound alerts on my system. And when those go off, that's when we take action. So you don't really have to sit here staring at the screen, although in some environments I will watch what's going on. For instance, right now I've been watching it pretty closely because there's a lot of volatility and things seem to be changing very rapidly, and I think a trend could develop very quickly. But for the most part, I'm just kind of watching things all day long, and I may distract myself with some administrative work so that I don't have my face in the screen, but we're operating on the basis of audio alerts that tell us when to act. And so for the most part, you don't have to spend a lot of time babysitting everything. And I am going through my systems. I use William O'Neill Direct Access, which is basically a front end, an analytics front end to O'Neill's database, and just screening for stocks and new ideas and maybe building my watch list that way. But it's really, successful investing is really a very simple process. And I've noticed when I try to make it too complicated is when I can run into trouble. So, that goes on till 1 o'clock, and then at the close we run some screens just to see what happened in terms of the stocks we've been watching and whatever other new ideas may pop up. So, for example, today I'm running some screens midday, and I'm seeing some short sale situations popping up and hitting alerts for me to go short this market, which I actually did earlier today.
Okay, let me interject here though, because I want to kind of lay a foundation more. Okay. So you're discussing watch list, you're discussing intraday time frame. So I'm assuming you are looking at decision making intraday, and it's not, for example, only daily bars or weekly bars. You are looking at less than a day bar.
We might be looking intraday if we're interested in, or if we're seeing an inflection point where we need to shift trend. And actually today we saw a situation where the market was looking good in the morning. We've been long and actually making some money the past couple of weeks, but today I think we had a significant reversal, so we'll take action on that basis. So, yeah, there are points at the point of impact. There may be a period, it's not too long, and it's mostly earlier this morning, where I do have to pay a lot of attention to what's going on the screen. And then once we've set our positions and we have our stops in place, then you pretty much leave it alone.
Okay. Let me also ask, because you're mentioning your watch list. Obviously, we all have limited capital, so we all can't trade everything. What constitutes a watch list for you? Like, what is the basket of markets that you're following in your universe, and how does that kind of ebb and flow? How does that change?
Well, whatever comes through my screens, and they're mostly technical screens. We look for certain types of buy points, pocket pivot buy points, Bible gap up. So any stocks exhibiting technical strength, that initially leads us to the name, and then from there we'll go and look at it and break it down in terms of the fundamental characteristics that O'Neill identified for big leading stocks, such as the Apple and other big leaders that you've seen in the past. So we're pretty much matching up what we're seeing in real time with those characteristics that our screens are looking for. But really what takes us to things on a daily basis is whatever's showing up with the right technical action to get through a particular screen that we're using.
Okay, your stocks only, though. That just is another laying another...
Well, I'm into precious metals these days. I actually am long physical gold, but I've been long it for the last 12 years. And don't see any end to that trend. So there's another aspect to what I do also is long-term position in commodities, and that's really been a no-brainer trade for the last 12 years. So in that part where I trade commodities, I've just been sitting long gold, physical gold, for the last 12 years.
So and to clarify also on your watch list, so you are really... Is the universe of equities narrowed down, or are you looking at what universe of equities are you looking at? Are your filters applying to the whole universe of equities?
All U.S. stocks.
All U.S. stocks.
And ADRs, yeah, that's what we're screening for. I mean, U.S. markets tend to be the most liquid, most accessible for us, so that's pretty much where we focus. We haven't found that we need to go anywhere else. I know that global investing is big, And I think on an allocation basis, and maybe that's true if you're into mutual funds or sector allocations or things like that, ETFs. But I think when you're focusing on stocks, we prefer the more liquid U.S. markets. And also, I think the accounting standards in the U.S. are better. And we've found out with a couple of Chinese stocks that, yes, not everything is as above board as you might think. Yeah,
it looks like I'm going to be giving a speaking gig in Beijing and Shanghai in August. So that will be my. I've talked before in Hong Kong, but I'm very curious to see just see the atmosphere there. But let me go into a line that I saw in your book, and I think I know what it means, but I want to let you kind of address it. And okay. I think it was an issue about diversification, and it was the phrase "kissing all the babies." And I think since we're talking about your watch list, I think it probably dovetails well into that.
Well, that was a phrase I got from Bill O'Neill, and he would say, well, you can't kiss all the babies. And basically what he means is you've got to find the right stocks, and there may be 3 or 4 that are doing well, and maybe you want to focus on 1 or 2. If you start getting too distracted with too many names, he felt that would put you at a disadvantage. And, on his quote screen, I used to notice he maybe had 10 or 15 quotes up on his screen in really big, like inch-high letters on his monitors. And so he didn't really busy himself with looking at too many names. And so I tend to look at what I think are the very best names, and that's generally sorted by relative strength. Those names acting the best is where I'm going to gravitate, as well as those stocks showing the best institutional sponsorship. In other words, I'm often looking to see who is buying the stock in the institutional world. Are these the smarter funds or the dumber funds? And I generally want to see that the smarter funds are moving in, and hedge funds as well, are moving in on a stock that I'm interested in. So that's one way I will narrow it down.
And this is one of the reasons I wanted to talk to you today, is because I think from the pure price action, trend following world of a lot of the guys that are in my books, and this gets back to my kind of parallel universe thing that I made with Japan in the beginning, is that I think we're both going to the same place, but you've learned and developed trend trading methods, trend following methods that are ultimately trying to do the same thing, but just getting you there in a different way. Do you concur with that assessment?
Yeah, definitely. O'Neill's system is a trend following system at its core. The whole idea is once you get on board, like Jesse Livermore said, the uncommon man, or it's the uncommon man who can sit tight and be right. In other words, you make a right decision and you let it run for you, and that's really what the O'Neill system is all about. O'Neill used to say that it's very easy to pick a winning stock, and you can pick Apple, you can pick any number of big leaders from the past. Anything from Google to Apple to some of the cloud names recently, whatever. And it's not so much picking the stocks themselves, but how you handle them. In other words, how do you handle the trend? How are you able to sit through the inevitable pullbacks within a trend while still being able to understand that the trend is still intact and psychologically staying on board for it? That was really the big part of his approach, I thought. And that's really where I made the jump from just being a stock picker, a stock jock, as I was when I was a broker, and actually learning to run money his way, which is riding a trend and riding it for all it's worth.
Well, I think one of the things that you probably agree with me on too is that you don't have a preconceived idea of where it's going to go, how far it's going to go. I mean, you don't know.
No, you don't know. I mean, like with the gold thing, I figured that you had a change in trend, and I saw the change in trend back in 2000, so I went long gold, and I've not seen a reason to sell it since then. So yeah, and I couldn't tell you when it's going to end. Maybe it ends tomorrow. Who knows? That's really the essence of it, is trying to find a trend, find a vehicle to ride the trend, and then sitting. I mean, that's really the essence. I think that's most of the people you talk to. That's exactly what they do. And in fact, I had a lot of trouble in 2009, Michael, and one of the ways I got back on track was reading your book, Trend Following. And that sort of reminded me who and what I am, because when I left O'Neill, I went to go run hedge funds. It's a completely different world. Monthly performance suddenly is the most important thing in the world. If you have a 10 or 15 or 20% drawdown in 1 month, oh my God, it's the end of the world. And people start freaking out. To me, that at O'Neill, that's the most foreign thing I could think of. Yet, running money in the public realm, running hedge funds, that's what suddenly took on so much emphasis, to the point that the people I was running money for literally would freak out on a 15, 20% drawdown. And then that throws me off, and that threw me off terribly.
Now, the benchmark scarlet letter that has to be worn by most hedge fund managers managing any kind of money is it's just not it's not appetizing. Look, there's billions of dollars to be made doing that. And, but I'm sure there are plenty, as we talk right now, I'm sure there are plenty, and this might sound crazy to people out there, but I'm sure we could find multiple billionaires who have sat on the edge of their chair their entire life, have catered to clients, and literally are frazzled nerves of who knows what. And they've done this for 25 years, perhaps, and they've made billions of dollars. But you know what? I'll bet you their life has sucked.
Yeah. In a lot of cases, they have no life.
And I think people need to understand that it really, you have to make decisions. I mean, look, sometimes I always say making your first million is really not about luck. It's hard work. But once you get past $1 million, or multiples, it starts to become, there's an element of luck. And, there really truly could be a guy who's running a fund and his fund blows up from 5 million to 20 billion. I think that's a great example. And I think that's a great example that applies to Winton Capital. I take absolutely nothing away from David Harding, immensely successful, but he did go from a very small amount of money and fairly quickly, a little over a decade, to 20 billion. Now, there could have been a trader, and I actually think David probably has the right mentality about this. I don't think it eats him up, but there are funds out there, as you mentioned, where you get caught to those folks that are calling you all the time saying, "What's going on? What's going on? What's going on?" And, I mean, how did that make you feel? I mean, it must not have been good.
It throws you off because you look at my track record, and I made 11,000%. It's an audited track record from 1997 to 2005. Now, that was the end of the 90s, and you know as well as I do that the 90s were a parabolic decade, much different than the 2000s. But during that period, I'd regularly have 20, 30% drawdown, sometimes even more. But as a trend follower, you stay on track and you come back, and I've done it every time. When you go out and run hedge funds, you have a drawdown like that, and it's scandalous suddenly. And yet you're sitting there, well, wait a minute, this is what I do. This is how I've done it before, and now suddenly I have to create this great performance without any drawdowns. No can do. I think you even say that in your book. Your account can go, I think, from 100 to 200, but it might have to go to 60 first. And if you think you're going to get rich overnight, you can't do it. And that was the way I had done it before. But now all of a sudden I was placed in the realm where the expectations are that I was going to be able to do it, but without causing anybody any discomfort. And I think a lot of investors don't really understand that aspect of trend following, and that's where they fail.
Let me, since I think you can go in a lot of different directions here with your background, and there's so many different topics in your book. But one of the things I wanted to kind of just bring up, and I don't think I've brought this up in a podcast yet, but it's one of the, when people start to wrap their arms around the idea of trend trading or technicals, one of the favorite things that they often come upon that they want to either try or discuss because it's so interesting to them is, and once again, I'm not sure about my proper pronunciation here. Is it either Fibonacci or Fibonacci? I've seen it done both ways.
I've heard it both ways. I say Fibonacci.
Yeah. But that is one of that's one of the favorites that I will see people will bring up. And I thought maybe, I'm sure you've looked at it in some, it's one way or another, but how do you address when someone brings that up to you?
You mean the use of Fibonacci levels as trading levels?
Yeah.
I think they work mostly because a lot of people watch them, and I think a lot of technical stuff works precisely because of that. And that's why you can get thrown off by the minutia of technical analysis. So I would say, if somebody asked you to use Fibonacci analysis, I would say no. But I have to, I admit to sometimes drawing Fibonacci levels on my charts just for fun.
But fun's not for making money.
No, but it looks pretty, but that's about it. So no, I don't use them at all, and I don't know whether they're valid or not. Maybe they are for some systems, and maybe you could create a system that uses them successfully, but not for the way I trade.
Yeah. No, I think there's a lot of different, and I think, if I'm not mistaken, a lot of your work is the very robust, either simple moving averages or breakouts. A lot of the foundational aspects, correct?
For the most part, yeah. I mean, we have a couple of things. Pocket pivots are a more subtle buy point that we've had to employ in these choppy environments to get a little bit of a head start on positions and stocks that we're building. But for the most part, yeah, you've got it. Let
me take you to kind of a baseline psychological foundation to your work. And I think this applies to almost any trend follower's work. But the power of now, the right now, the moment, it's all we have. Why don't you talk about and kind of lay the philosophical foundation for the moment of now and how that, intertwines through your trading, your life, through your day?
Well, I think it's just like as in life itself, the history, the past is history, and the future hasn't happened yet, and you don't know what the future is going to be. All you know is what's happening now. And so from our trading perspective, all we need to know is what's happening right now. And so you react to what you are seeing in the present in the market rather than what you think the market should be doing or what you thought about the market yesterday or what you think the market might do tomorrow. You basically have to stay in the present looking at the information coming at you and interpreting it that way. That's how I use or how I look at the power of now in terms of trading, is staying in the moment and allowing any bias that you might have based on a prior opinion or position you have on. Sometimes people are bullish or bearish simply because that's the way they're already leaning, and I think you have to be flexible in terms of being able to switch. So even today, I was pretty heavy long today, maybe 180% long coming in today and doing very well. And I could see the turn, and so boom, we flip it. The alerts go off. We don't sit there and intellectualize about it. We just boom, we flip our positions and we go short. And now we'll be short until the market tells us otherwise.
Now, is the moment of now? Is that a choice for people if they want to be successful? I mean, is it really a choice? Or is the moment of now, from your perspective, something that is foundational to anybody who wants to profit in the markets?
I think so. Yeah, definitely. I think you definitely have to operate on the basis of what you're seeing in the market in the present, rather than opinions about what might happen and whatnot. So yeah, I definitely think it is an essential ingredient for success.
And I guess the reason I ask you is a slight setup on where I wanted to take you is that I think I talked to Jack Schwager about his new book recently. And I think obviously the Market Wizards books are great books, and everyone gets something from them. But Jack and I always have a little bone to pick with him, but Jack has always made the case, and I think I've seen you make this case a little bit too, is that you have to find the style that's right for you. And I almost think, though, I guess my argument I want to pick is that it seems like that's kind of a high level conversation, whereas
yeah.
Whereas the moment of now, you can't just turn off or on, meaning, so there's a lot of people that might have some other strategy that it doesn't exist in the moment of now. And I guess what I'm ultimately getting to is that if you want to profit in the markets and you say to yourself, well, I don't want to be a trend follower, that doesn't fit my personality. Is that really accurate, or is it more an issue of that person has just not learned proper technique yet? Like, where do you draw the line versus learning proper technique versus saying that doesn't fit with my personality? Maybe your personality doesn't fit with making money.
That's what the answer I would probably give, because to me, I don't understand how trend following is separate from making money in the markets. Whether you're trading micro trends or intermediate trends or macro trends, trends are always a part of making money in the market. And so to have the mentality that you don't want to use a trend following system, I think that's in denial of the essence of how money is made in the markets. It's even if it is just a short-term trend, even day traders, are using short-term trends. So I think that people need to understand that no matter how they're doing it, they are trying to ride a trend. Even a value investor is going to try and ride a trend to the upside with whatever stock they pick as a basis, for building their portfolio on the basis of valuation. So if you use valuation even to pick a stock, you're still a trend follower in that you're expecting that valuation to induce a trend. So, yeah, I think trend following is so basic. That's what I like about your books. I think it really boils investing and successful investing down to the bare bones of what it really is.
It's tough though, because I think when you look at the general public, I think it's I had somebody asking me some questions, and I said, well, since when? And he said, well, just recently. And I said, well, what does that mean? Recently, starting?
I think that's a cop out.
Right. What date are you talking? And this, yeah. I'm sure you've seen this kind of mentality before.
Yeah. Well, I think it's an excuse when you're having a difficult time in a market. Maybe just telling you you should be in cash and there's no trend to follow. But I think the whole idea that markets have changed tells me that you really don't have that much perspective on market history, because I think even a time like now, the volatility that we're seeing, there have been other periods that have been similar. So And a lot of people like to say, well, it's different now and you can't be successful. I don't agree necessarily.
Yeah. Well, and he ultimately, I pushed him into a corner and he came up with a date and he said since '08 and QE had begun, and I said, well, I said there's some research that shows that that all markets and human behavior has fundamentally changed since '08. But
that is one aspect. I mean, we debate this a lot internally. Chris and I debate this all the time. It's like, are the markets different, either because of decimalization? I think there might be slightly more volatility on a short-term basis because of decimalization. I think there might be some volatility as a result of QE. But I think QE just becomes a basis for a different type of a trend, but it's a trend nevertheless. And I think if you recognize the lows of March 2009 and saw that was a change in direction right there, whether it was caused by QE or Obama descending from the clouds and making all our lives perfect, it's still a trend. And I think you have to get away from the rationale for the trend and just focus on the trend itself and just get away from all the noise. So I think maybe the noise is different, and that's what people are perceiving, and they seem to think that means, the markets are different today, and I don't think that's necessarily the case.
I think we should frame what you just said in the last 30 seconds and put it on the wall, because I think it's the rationale for the trend in wanting to have the story. And what you're saying is, well, hold on, if you don't pay attention to the story, they just look like squiggly lines, and these squiggly lines have happened before, right?
And they're just as squiggly as they ever have been. But when you catch something, and I just used some examples recently, people say, most stocks, there's no trend, and you can't find a trend here, everything's choppy. Well, I mean, look at a company like Pharmacyclics, PCYC, Peter Charlie Y Charlie. I mean, that's a beautiful trend off the 30 level. That stock doubled in about 5 weeks. And there's a trend, you could have jumped on if you weren't so worried about whether this trend is any different than one 10 years or 20 years ago. So I think it's just, O'Neill used to call these alibis. People need an alibi for what the market's doing. You go on TV, I go on Fox Business News all the time. They don't seem to be interested in my analysis of trends. They just want to hear an alibi for whatever's going on in the market. And that's what O'Neill used to say. It's just an alibi. The market's doing what it's doing on the basis of what it sees in the future, not what's happening in terms of the news. And so the noise has nothing to do with it. The trend is the trend, and that's it.
Yeah, people want that story. They want that master narrative, and
they almost can't separate the two,
Oh.
I think that's a big flaw, and that's why most investors are unsuccessful, the vast majority.
Well, let me as we kind of round down here a little bit, I can't keep you all day, but let me throw out some big picture ideas, and I kind of just want to let you pontificate, let you explain, give your perspective. One of my favorite expressions, I saw this, it was in a Financial World magazine, and I actually took the picture and then put the picture online. So any picture of you that you see of this online is from my early 1990s Color magazine, where I took the scan of it or whatever. But it's a picture of Paul Tudor Jones, and behind him it says, there's like a tacked loose leaf piece of paper behind him, and it says "Losers Average Losers." and average, and I think it goes right along with your notion of talking about averaging down. So why don't you talk about that, and why don't you explain that piece of paper I just described, and explain the process, how it happens, and why it's a really negative direction to go as an investor?
You mean the process of averaging down, why people will do that?
Yeah.
Well, I think a lot of it is just denial, first of all. If you take a position, the market will tell you whether you're right or wrong pretty quickly. I mean, that's what I love being Mexican-American, is that the markets have no affirmative action. They tell you whether you're right or wrong right away. No favoritism based on race, religion, creed, or otherwise. So if you're not going to pay attention to the markets telling you, then you're in denial. And the first way you do that is by taking a position that turns against you and then adding to a bad decision. So I think it's a basic psychological issue of denial, period. And that's really the genesis of that, and not taking responsibility for your trades and wanting to operate on the basis of hope rather than a disciplined system. And so, but that's an easy way to do it. You buy a stock, it goes down, you got to buy more, because if you went to the store and you bought a shirt yesterday for $80 and today it's $60, it's a good deal. So this retail mentality, I think a lot of it there's another factor that drives this bias towards averaging down, is that people treat the markets as if, they're a retail consumer at the store, when in fact that's not really what's going on in the markets. And so I think that's the number one rationalization is that's like going to the store, and then I think the other one is denial, and so people can kick that one in pretty easily, I think, and so it's it's the path of least resistance psychologically.
Well, it's funny you mentioned about the retail store, like a Walmart or something, and you think about it, the blue light special or whatnot starts pumping, and all of a sudden the price drops. What people probably don't realize is, Walmart's in this to make money. I mean, there's like how many Walmart kids are like billionaires sitting around in Arkansas? I mean, clearly they can drop the prices to nothing, but they're probably making the things they're selling to you for less than nothing. So it's right. The value part there. Let me go ahead and, like I said, I want to kind of end with one thing, and I want to give you an opportunity to kind of explain this to people. I think sometimes I see a situation where very bright people, they could be college graduates, could be an attorney, could be somebody in the service industry, a doctor, and they do very well. They make their money. They've saved up money, and at the moment they say, "Well, I want to invest," it's like they dabble. They don't really think, or they don't really put the time in, and then they make some quick hit type decision. Can you speak to the idea of that if you have this career over here on the left-hand side of the ledger and you want to enter the world of Gil, that you can't just come in with one arm tied behind your back wearing a blindfold, that you actually have to do some work?
Exactly.
You got to say more than that. You can't let me just say it all.
Well, I think there's a couple of traps there, and the first is that if you were a successful lawyer or doctor or entrepreneur or whatever, you obviously feel like you know something. And so there's a tendency, I think, to have some ego that whatever your intellect is able to weed through and decide on, that's obviously sacrosanct because you were so successful before. And so some people like to think that the success they had spreads into investing, but I think they're kind of missing the boat, because if you're a doctor, just ask yourself, did I dabble in being a doctor? If they're a lawyer, did I dabble in being a lawyer? Did I just kind of pick this up and start doing it out of thin air like I'm trying to invest? And I think a lot of people don't really understand that investing is a vocation, and I think that's how they have to approach it. It's not a hobby, I don't think, unless you want to lose money, but might as well go to Vegas. That's a better hobby then.
Yeah, Vegas is more fun. They get better food and interesting sights.
But I think that's one of the reasons you see people do that, But I think they just need to go back to this, asking themselves a question, and whatever they do before, how long did it take to get very good at that? And I think it takes the same amount of effort and time investing.
Yeah. Well, listen, Gil, I'm not going to keep you. But how can people? I'm going to go ahead and make sure I give the exact title, because this is if you, after you finish reading this, I have to say though, you can kill somebody with this book. It's a nice, thick, solid book. You could beat someone with this thing. But it's kind of like my first book. So, Trade Like an O'Neill Disciple: How We Made 18,000% in the Stock Market. Gil Morales, Dr. Chris Kacher. Kacher. Yes, I've got. In the Rye. And of course, I've got one of these weird last names too, where people say Covel or they say all kinds of.
It's Covel, right?
It's Covel, shortened from Kovaleski, shortened from Kovalauskis.
Sounds like Lithuanian or something?
Lithuanian, yes. So
yeah, that sounds like.
Yeah,
okay.
You mentioned no affirmative action. I wasn't sure where you were going with that, because you said Mexican American. I was like, well, hold on, he was at Stanford. I'm like, I'm Lithuanian American. Don't I get like a free membership card or something? I mean, I should be getting somewhere too.
Maybe somewhere. But that's the beauty of the markets. There's no affirmative action. You either succeed or fail on your own merit, and nobody's there to pick you up.
Isn't that's a great way to end things though, because that is truly. And I have a feeling we haven't discussed kind of political philosophies or whatnot, but I have a feeling you're in the same space, which is like, look, you wake up each day, you work hard, you make something happen. You don't expect a bailout, you don't expect a handout, and just go do something. And stop worried about all the silliness out there, the color of skin, where you were born, all this other nonsense, because no one cares. At the end of the day, it's Gil, it's Mike. We're alone, ultimately. No matter how many friends and family around us, we're alone.
And that's, by the same token, that's the beauty of it, and that's why I couldn't do it any other way.
Yeah. Gil, where can people, I just mentioned the book again, but where can people, if they want to connect out with you, I know you're on Facebook. If you're connected with me on Facebook, I'm sure you can find Gil that way too. But what is the way they can reach out and find you?
Well, the website, selfishinvesting.com.
Okay.
You can go check it out, and that's where I'm at with my partner, Dr. Chris Kacher, and all our fun stuff is there for people to check out.
Okay.
That would probably be the best place to go. I also have gilmoreport.com, GILMO report.com. That's a newsletter I write twice a week, so people want to check that out.
I think the next time we talk, the next time we talk, we might have to get the portable recorder, and I'm going to pop up to Playa del Rey because I do love that area too. So. Yeah,
definitely. And I'll be in San Diego in a couple of weeks, heading down to the Costa for a few days.
Yeah, absolutely. Drop me a line. We'll do a second conversation. Grab a lunch.
I'll shoot you an email then. Very good.
Thanks, Gil. Appreciate it. Talk soon.
Oh, Michael. Yeah, thank you. Take care.
Bye-bye.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.